Thanks for clicking. It's unlikely that Canada's real estate market will get a boost from the Bank of Canada's rate hold. This according to BMO economist Robert Kavcic. Kavcic, if you'll remember, made headlines during the pandemic real estate bubble, arguing that the supply arguments were a myth, and the major upsurge in pricing was being caused by free money.
Everything that guy just says is bull.
And then, as we all know, the bubble burst when the free money went away, real estate values plummeted, and then kicked back into high gear when the Bank of Canada paused in January. And with many saying that the bank's recent hold on rates will be good for the real estate market.
But we do think, especially now with the Bank of Canada's decision, we'll get that stability and people can take a bit of a sigh of relief.
Everything that guy just says.
The big question is, will this pause reignite the market in the same manner that we saw earlier this year? So what I want to do today is go over Kavcic's interview with Bloomberg, take a look at why he says that this time could be different, and then discuss what to look for next. Speaking of next, we do have a big couple of weeks ahead of us with the CREA set to release the national sales data for August any day now, and Canada's inflation data for August being released in a little over a week. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the interview. Following the central bank's announcement last week that it would be holding on rate hikes, Bloomberg asked BMO economist Robert Kavcic if this would result in a reinflation of the housing market, similar to what we saw earlier this year.
Do you think that this pause by the Bank of Canada is going to have a similar effect, or did the last two hikes, change the equation?
And it's a decent question. The bank hit pause on January 25th of this year when the average home price was $612K, down from the previous February's $816K. By the time the bank had resumed rate hikes in June, the average price had jumped up to $729,000 in May, a $117,000 increase in just a few months. But will it happen again? Kavcic says maybe not so much, especially with rising unemployment.
There are a few things out there, like we've seen a little bit more slack kind of creep into the job market. The unemployment rate's up, half a tenth or a bit more in the past year. It's something.
Indeed, Canada's unemployment rate, while remaining at 5.5% last month after 3 consecutive months of increases, is showing signs of slowing down. With agriculture, manufacturing, educational services, and real estate and finance all showing major slowdowns.
We had a good thing, you stupid son of a...
And of course, when job losses add up, demand for real estate falls. But in addition to this, says Kavcic, one of the biggest differences between earlier this year and what we're seeing now is the major increases in inventory.
We're getting a lot more listing flow in the market as well. So back in the spring, one of the reasons prices really came back so quickly was there was just really nothing out there to buy, right, in the resale market. That looks quite a bit different right now, and we're getting more supply.
And yeah, we've talked about this before on this channel. We're seeing a major increase in the number of properties coming to the market, an uncharacteristically high number of properties coming to the market for August, despite all of the summer market slowdown arguments that we've heard.
Worth a shot.
Indeed, a new article just released by the Toronto Star showed that investors are dumping their properties amid higher cost of borrowing. Most of these investors took variable rate mortgages and can no longer afford the ever-increasing cost of borrowing. And this data falls in line with what we saw earlier this year, when, back in February, a poll found that 45% of variable rate holders would only be able to hold on to their properties for about 9 months.
Tell your friends.
That was about 8 to 9 months ago, and rates were 75 basis points lower. So we have much more supply coming to the market, and Kavcic says that is going to coincide with a reduction in demand. We're not going to see similar levels of demand that we did earlier on in the year.
And then the biggest thing, I think, is if you remember back in the spring, market and forecasters were really talking about and pricing in a recession. You saw a pretty big rally in bond yields into the spring, and we actually got some significant mortgage rate relief in like the 2 to 3 year fixed rate space in Canada. We're not seeing that this time around at all. And so the lowest available mortgage rate out there right now is still a good 100 basis points higher than the lowest available back in the spring.
And that's definitely a good point. Bond yields tanked back in the spring. Back in April, RBC had a 5-year fixed insured rate sitting at 4.94. Fast forward to right now, and that same rate is sitting at 5.69. And the spread between last year and right now is even higher when you look at some of the other lenders. So that is going to put a real crimp on buying power, especially since it looks like bond yields and the fixed rates which accompany them are not going lower anytime soon. So, all in all, Kavcic is saying that with unemployment rising, a flood of new inventory coming to the market, and major demand reduction brought on by higher bond yields, the real estate market is unlikely to see the bump that it saw earlier on in this year. And I think Kavcic's point about a flood of new listings coming to the market is going to be the story of the day when we take a look at the fall and winter markets. We're seeing story after story about stresses on homeowners with adjustable rate mortgages, and even OSFI is warning about the renewal shocks for holders of variable rate mortgages with fixed payments. And that's not even to mention that the readvanceable limits on home equity lines of credit are about to be reduced significantly in the coming months ahead. OSFI is forcing the banks to dial back the readvanceable limits on HELOCs, dial them back to 65% of the home's value, which will obviously put more pressure on those who've been relying on their home equity lines of credit to make their payments. And all of these pressures, the weakening of the economy, the increase in the cost of borrowing, the reduction of demand, were all just starting to build at the beginning of the year. And now, 9 months later, the bank has paused again, and those pressures have had some time to ferment. Judging from the major increases in listings that we've been seeing, as well as the increase in interest rates and the reduction in demand in the real estate market, the reduction in buying power, it could very well be different this time around. The real estate market might not retake off again in the same manner in which it did after the last rate pause. With that said, we will continue to track Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.